Green Banks, Government, and Lessons to Support Our Energy Future with Richard Kauffman. Thanks for joining us at Energy Matters with Claire and Dan. Dan's away today at the National Renewable Energy Lab, so I have the pleasure of being joined by Richard Kauffman, a longtime friend and colleague. Richard is currently the CEO of the Coalition for Green Capital, a $5 billion national green bank. Prior, Richard was at the New York State Energy Research and Development Authority and is currently the lead independent director at Generate. I'm excited about this conversation because Richard is in the intersection of investment banking and federal government and state government and how all of those entities together can forward the promotion of climate tech and energy technologies across the United States. Richard, thanks for being on the show.
Well, it's great to be with you, Claire. Just you is fine with me.
Thank you. So, Richard, you and I have been in the energy industry for a long time. When our paths first crossed, we were both at SunEdison, and then we both worked at the Department of Energy together. But tell me a little bit about what you did prior to Department of Energy and then why you joined Department of Energy.
Well, I had a very long career in finance and investment banking. My last job was as a partner at Goldman Sachs. And I had always thought that I would take what I learned in finance and do something that had more social utility. And so more than 20 years ago, I got involved in investing in renewable energy through a firm called Good Energies. And I hadn't been an energy person in my time in finance, but coming in from the outside, I could see that there were many market imperfections.
So you went from Goldman Sachs to Good Energies. Tell us a little bit about what Good Energies did.
Well, it was interesting because Good Energies, the bulk of the investments that Good Energies had made were in Europe and in the solar sector. And that's how we connected in terms of SunEdison. So and it was obvious to me, being in the United States, the really fundamental difference in policy between Europe and the United States. In the United States, to the degree we had energy policy with respect to renewable energy, it was let's try to innovate and then deploy. And in Europe, it was the other way around. Let's deploy and the innovation will follow.
That's very interesting. So Good Energies partnered with SunEdison to develop a bunch of PV projects, especially in Europe, and then invested in a number of PV technology companies and investment companies. How did then you switch from Good Energies to Department of Energy?
Well, the world is still a very small place in the renewable energy world. And because I saw the importance of policy, I was often asked to go down to talk to people in Washington to talk about policy. And people in Washington were interested in hearing about what investors were doing. And so I wasn't a political person, but as the Recovery Act policies were winding down, and if you remember, the Obama administration was very worried about the government being too involved in the private sector. So many of the Recovery Act programs were designed to sunset. The question was, what was going to be next? And so I was hired to sort of be the business guy at the Department of Energy to come up with the next set of deployment policies. But unfortunately, literally the day before I started, Solyndra filed for bankruptcy, and the idea of the next set of renewable energy policies for deployment did not happen.
Right. And that was after, so I was at the Department of Energy in 2009 and 10, and I reported to Matt Rogers, who was ex-McKinsey, and he reported to Secretary Chu. We were responsible, well, me particular was responsible for deploying about $11 billion of the stimulus package during the Obama administration, particularly for weatherization assistance program, state energy program, energy efficiency, conservation block grant program. And so we were really sort of passing the baton to you after that fact. but the loan guarantee program was also working at that time. So, just for listeners who aren't comfortable or familiar with the Solyndra story, tell us why that was so important for the federal government and the private sector.
Well, so Solyndra was an innovative solar manufacturing company. It had received a loan guarantee from the Department of Energy Loan Program Office. And it was certainly an innovative technology that had the promise of reducing costs. What happened, however, in the solar industry was that China decided to rapidly commit itself to solar manufacturing using the conventional silicon-based technology. And so costs of conventional solution turned out to be cheaper than the innovative solution that Solyndra had. And so Solyndra had to go bankrupt. And unfortunately, this was one of the very first loans that the Loan Program Office had made under the Obama administration, and it became a political weapon, unfortunately, that the Republicans used against the Obama administration. And it is really the turning point of the politicization of clean energy. There were more documents that were produced for the investigation of Solyndra than there were for the whole investigation relating to Hurricane Katrina.
Which is just shocking. And now looking back in 2026, it's very interesting because if you look at how much money Elon Musk and Tesla has received from the federal government, do you even know, Richard, how to compare those dollars amounts from between Solyndra and Tesla?
Oh, well, what I can certainly say, because I was there at the time trying to manage that portfolio. There was an independent review of the portfolio at that time that was commissioned by the White House, and it said that most of the loans that had been given by the Department of Energy's loan program were in projects that were deployment, not manufacturing. There were solar farms or wind farms and so forth, and that these were low-risk propositions, and that the income from those projects would be more than offset any losses that would result from loans in manufacturing, and that has certainly been the case.
So, I mean, a lot of the reason for the American Recovery and Reinvestment Act, or ARRA, signed in 2009, there was $90 billion provided for clean energy, including for companies that grew rapidly like Tesla and large projects, as you say. And Tesla worked beautifully, obviously. And, it just interesting that Elon Musk has been so anti-government, given the fact that his company, Tesla, only exists because the funds from ARRA helped launch Tesla's original assembly plant.
I have no other comment about that.
Okay, understood. So let's talk about, what's changed between your good old days at Good Energies and the Department of Energy, and what stayed the same from your perspective, whether from a government perspective or not.
Well, I think quite a lot has actually stayed the same. Certainly the trends that we saw really 20 years ago, many of them are still the same. In other words, costs of renewable energy solutions continue to decline, and electricity rates continue to go up even before the AI boom. We talked about China. We could see the emergence of China almost 20 years ago, and of course that's now expanded not just to solar, but wind production and electric vehicles. I think the same thing, that we looked at a long time ago in terms of the role of the United States. The United States is a patchwork of leadership. In other words, there are some states which are leading and other states are not. But in the aggregate, the United States is not, unfortunately, a leader when it comes to deployment. You can look at a whole range of other countries. You can see the huge increase in solar that has taken place in terms of deployment in Pakistan. And of course, in Europe, the war in Ukraine has also stimulated the desire for more deployment of non-fossil based solutions. So I think that a couple of things quickly that are the same. The utility business model, again, needs reform. I think the still complex sources of financing, reliance upon project financing and tax equity, and still limited use of stock and bond markets, still hard to finance hard tech startups through commercialization. So you also asked what's different. Okay, so what's different, I guess, in the United States certainly has been the emergence of corporate purchasers. And maybe now we were worried a few years ago about greenwashing. Now maybe we should say that what's going on now is green shielding. In other words, companies are
Right.
still doing stuff, but they don't want to necessarily be so visible. I mentioned the war in Ukraine as an enforcing factor, and the AI boom. Certainly, the forcing function in some respects that we've been looking for. I didn't mention, by the way, electric vehicles. Electric vehicles is an example of a tale of two things. I mean, certainly the growth in electric vehicles outside the United States, with slower growth in the U.S. And I guess on the financing front, I guess what's different is we have seen now the rise of private credit funds because there's a shortage of traditional project finance from banks, and also the rise of growth equity investors. And one of the challenges I know that you experienced is the sort of missing link in financing between venture capital and project financiers. And in other sectors of the economy, that's growth investors, and that had been lacking in the clean energy space, and now there are more growth investors.
There are more growth investors. I would argue there's infrastructure investors that we didn't see 15 years ago, right? We talk about Fifth Wall and the CBREs of the world that are infrastructure investing in both technologies and in financial entities that didn't exist 15 years ago.
Yes, I think that's right, because I think the point about the deployment, these large wind and solar parks, you really should think about them as being financial assets, in a sense more than energy assets, because they pay off a very predictable set of cash flows over the long term, and pension funds and endowments really need long dated fixed income instruments, and bond yields, have been quite low, and so these have been really very attractive instruments for those kinds of entities that have long dated liabilities.
Yeah, I think that's very relevant, and it's been the last 15, 20 years when people have realized that these project financed deals actually are future streams of cash flow at the end of the day.
I mean, going back just to the loan program, one of the things that the loan program did was to demonstrate, ironically, I mean, it is sort of shocking when we think back on it. There hadn't been a really large scale solar project financed.
There were some small ones. I mean, at SunEdison, we financed Nellis Air Force Base, which was a 10 megawatt install in 2006, 2007. But yes, nothing huge, nothing that took hundreds of acres. Right.
That's right. And so I was using conventional technology largely, and that demonstrated to the market that this was a financeable asset. And that unlocked, obviously many, many, many billions of dollars thereafter.
So let's shift gears for a little bit, Richard. Tell me why you went to NYSERDA, and tell me a little bit about some of the things you were most proud of when you were at NYSERDA.
Okay, so I had the opportunity to be the New York State Energy Czar, although I was always
loved that name, Richard. You look like a czar.
Yeah, well, I was not so happy with the name because it didn't work out so well for the czars. But I had, in addition to NYSERDA reporting to me, I had the Department of Public Service, the New York Power Authority, and actually the Long Island Power Authority reporting to me. So it was really New York State is unusual to have all these sort of energy government assets. So, I think that I really liked the opportunity, having been in the private sector. the chance to serve in the public sector, particularly because my background was in finance. Government does a lot of finance things, a lot of business things, and unfortunately, there's a real gap of knowledge in about how the private sector works in government, and actually government, both at the state and federal level, at least from what I saw, government officials really understand that they need to mobilize private sector capital. And so it's really an opportunity for somebody like me, where I was one of a million people doing finance in the private sector, the opportunity to really feel I could make a small contribution working in government.
Oh, and you absolutely did. And I think it was really groundbreaking that Goldman Sachs investment banker, chose to really spend the latter part of your career trying to serve the public in new ways.
Well, thank you for the word ladder. So in terms of, I think probably, I think there are probably a couple things that I'd point to that we did that I think are still maybe relevant. I mean, the first is that New York State, like other states or like the federal government, the way it supports clean energy projects is in the form of grants. And the problem with that, for example, at the state level, is that New York State, even as big as New York State is not going to have any influence over the hardware costs of a solar, wind, or fuel cell. But we can have an enormous influence on soft costs, on the soft costs of customer origination or permitting or installation or financing. And so trying to reorient the public dollars to reducing soft costs was one of the things that we were most, I think, probably the proudest of. And ironically, offshore wind is a really good example of what we did, because we know that in the United States, what we had done in the past was struggle to build one innovative project, and it'd be really expensive. And then rather than being the first of many, it was one of a kind. And so when we thought about offshore wind, we said, we don't want to do that. We want to try to build a sustainable market. And so what we did is a bunch of stuff that reduced soft costs, because we did all the pre-development work, a huge range of environmental studies. We got local community support. We established a line of sight of a market that would draw in the European developers. The New York Green Bank strategy is fundamentally different than the loan program. And it's really in a couple of different ways. One, in the New York Green Bank, we didn't lend to manufacturers. It was only in deployment projects. But the most important thing is that we were focused in on areas where there were gaps in financing markets, where the problem was the availability of debt, not its cost. We did not offer subsidy. And the challenge at the DOE loan program is that DOE was giving out subsidized credit, cost basically treasury. And so there was always the question of additionality. How do we know that the project wouldn't otherwise happen? If you're actually charging market rates and companies are doing business with a state entity, nobody really wants to do business with a government entity. It's sort of the question of additionality goes out of the way. It meant that by definition, we were filling in a market gap. And the other issue there is we were drawing in private sector capital, and there wasn't a perception from banks that we were crowding them out. And in fact, what we did was to actually act as an incubator. And a good example of this is in the solar area is community solar, where banks had gotten comfortable lending to rooftop solar, but this community solar thing where it's a solar on the ground miles away from where people live, how do we know that customers are going to keep paying? What happens when somebody moves? All those kind of questions. And so banks were reluctant to lend to community solar projects, even though there's tremendous commercial demand for people that wanted to have a community solar participation because they couldn't put it on their roof.
Right. The roof was
And
shaded or they were renting a space or something like that. And now, 2026, we see, the community solar has been commoditized in the sense that you can just hire a subscription organization and they assume a certain cent per kilowatt hour to get that customer, and that those customers will be recycled over time. And they have, data analytics about if low and moderate income customers are required, like they're required in Maryland, we have a certain restocking rate, basically. And all of that has become a market in part because of the work that you did at NYSERDA.
So the issue here at the New York Green Bank is it had to develop the financing structure, because these are project financing type structures. And so a lot of contracts you have to develop, a lot of things to ensure that lenders are protected. So all that hard work the New York Green Bank did, and then the New York Green Bank built a portfolio of community solar loans to demonstrate to banks that these were creditworthy. And now the private sector participates now in community solar loans. And so this is a really good example of a tremendous return on public dollars, because in contrast to a grant, which goes out the door and it does a project, but that's the end of it. In this case, not only does a Green Bank dollars get repaid in the form of interest income, but in addition, it has been transformative because now the private market has taken over. We want to be put out of business in terms of what the Green Bank does. There's an ever-evolving frontier of opportunities, different kinds of technologies, different types of customers. And so we want to always be at this ever-emerging frontier of where there's a financing gap. And that's the last difference, I think, with the loan program, is that the loan program, unfortunately, because it's at the federal government level, has so many structures, it can't always move at this evolving frontier.
Right. And I would argue, Richard, I'm interested in your thoughts. I mean, each state Green Bank has functioned a little differently. So I love Brian Garcia at the Connecticut Green Bank, but they have taken a different tact than the New York Green Bank has taken a different tact than what Maryland's fledgling Green Bank is. Why do you think that is?
Well, different policy objectives. I mean, I think that this is a really complicated question in some ways, because I think that the criticism of the New York Green Bank is that it is enabling the private sector, and it is filling these market gaps.
But I wouldn't call that a criticism. I mean, I hate to interrupt you, but isn't that exactly what you were designed to do?
It is, but I think that there are some people that would say, well, if you're giving out public dollars, you should be providing low-cost loans to customers that can't participate in the market. And I think there's the question about whether, is this, my own view, it's my own philosophy, is that the maximum return, as it were, on public dollars ought to be to harness the market, but not everybody can be served by a market-based solution. And so that's why other green banks have a greater focus on providing subsidy to lower income customers. And by the way, this also irritates me because not all low income customers, there's a presumption that low income customers require subsidy, and that isn't always the case. And so ironically, I think we can actually crowd out those entrepreneurs and those people that want to serve those customers, which would have much more money if it was market-based to deploy, but we crowd out those people by just assuming that people with less money always require subsidy.
Right. Well, we could have a whole podcast on that, Richard. And channeling my inner Dan Kamen for a moment, I think that's absolutely right. I mean, what level of subsidization is required so that low and moderate income folks can join the new energy revolution, and what is required. But let's put a pin in that for a moment. I think I'd love to hear a little bit more about what you're doing with green banks today.
Yes, so terrific. So the challenge with the New York Green Bank or the Connecticut Green Bank is that those entities are funded from collections on customer utility bills in that state. So it means that the Connecticut Green Bank can only fund projects in Connecticut, and New York can only fund projects in New York. So for, I guess, over 15 years, the Coalition for Green Capital, or CGC as we're called now, advocated for the creation of a national green bank. And so as part of the Inflation Recovery Act, CGC received a grant for $5 billion to create a national green bank. And it's unfortunate because of that $5 billion, $2 billion has been frozen, and we're in dispute with the federal government. But the intent of what we are doing, is to really follow the lead of the New York Green Bank. And again, to focus in on areas in the market where the problem is not the cost of debt, but the availability of debt. And the irony in terms of the fighting with the administration is that the administration is appropriately concerned about the growth in demand for electricity, for onshore manufacturing, for AI, and is also concerned about affordability. We're concerned about the same things, and often the quickest and cheapest ways of solving or helping to address the demand in energy are distributed solutions: solar, storage, fuel cells, geothermal, energy efficiency solutions, and so forth. These are, and the reason why they're cheaper is because the technology in themselves may be cheaper, but they avoid the increases in distribution costs. And distribution costs represent the largest percentage increase in rates that we've seen. And I guess finally the use of the word irony, it's often these kind of projects that have the most difficult obtaining financing. So smaller projects, and when I talk about small, I'm not talking about $1,000. I'm saying it's difficult sometimes to get a loan of $50 or $75 million. And this is exactly our sweet spot.
At the Coalition for Green Capital.
Yes.
Yes. Yep. Yep. I mean, that's what we're doing at Sunrock today, is we're focusing on what we call the messy middle, the sort of 150 kilowatt to 5 megawatt size projects, because there's tons of financing still available for utility scale projects. Residential has changed a bunch with the Inflation Reduction Act, but there's still billions of square feet of roof space that haven't been addressed, that could be addressed, that don't have these transmission and distribution requirements. And we had a whole episode on Energy Matters with Claire and Dan about what's going on with FERC and Maryland specifically, funding a big 50-plus-year-old coal-fired power plant. It sure seems like there is a lot of incentive structure designed about continuing to fund the big utilities and enabling them to charge ratepayers for transmission and distribution upgrades.
And those are easy to finance because all the funds you talked about that have been created, they're big funds. That's how, it's a business of asset management. And these big funds want to deploy big dollars. So there's a messy middle in the financing because there aren't many entities that want to participate, because it takes just as much work and just as much effort to figure out how to finance a small project as a big project.
Well, I'm going to push back there a little bit. I'm interested in your thoughts. I mean, I think I am surprised that utilities across the board, and I know every utility is its own special snowflake and has different requirements, and different parts of the country have different weather patterns and different base and all of that. But I am surprised that they have not addressed, as a general rule, financing and supporting distributed energy more broadly, because it would solve a lot of their transmission and distribution problems.
Okay, well, this is again, and maybe another podcast. So I guess,
yeah.
So I guess a couple of things. Obviously, in there are restructured markets in places where utilities own generation, So I think that, of course, there's an inherent bias for utilities, and understandably for central station solutions, because they're easier to manage and control and see. And so utilities are always
And it's
very
how they're
worried.
incented, right? I mean, it really is how utilities are incented, is to develop big power plants that they can rate base and charge their customers for, right?
Right. But I mean, there's the operation part, and now you're talking about the financing part. So the financing part is, the more capital, that's how utilities get paid, is a return on the capital deployed. And both those incentives, or both of those incentives obtain across the country, whether we're talking about utilities that own generation or not, because even the wires companies, like in New York State or California, still have difficulty they ought to be indifferent. They just have wires. They ought to be indifferent about supporting one kind of generation versus another. But again, if there's less capital that's deployed for supporting a distributed solution, less capital deployed that's required in terms of upgrade of distribution, they're going to have a financial disincentive. And that's why I said at the beginning, one of the things that hasn't changed is the utility business model. And this is something that needs to change. It is one of the things we did work on in New York, but a lot more work needs to be done in that area.
Yeah, and it really does require its own set of podcasts, because each state really is different. And I don't fault the utilities at some level, in the sense that their incentive structures are to build, depending, again, whether you're talking about the generation side of the utility or the transmission and distribution side of this utility. Their job is to make sure that people's lights turn on whenever we request them to do so.
So
right?
maybe we should talk again about the non-wire solutions and some of the other thoughts that we might have about how to revise the utility business model.
Yeah, I'd love that. I think just to, sort of to wrap it up, I guess, Richard, is why do you have hope or not for the future of the climate tech space?
Well, I guess there are two bits of hope. One bit of hope is this forcing function. I mean, there's nobody really around in the policy or utility space that was around the last time we had such a dramatic growth in demand for electricity. So this is the forcing function that we need. And so the fact that we have this affordability crisis at the same time that we have demand growth for electricity, this is the time where to have these kind of conversations can lead us to make some fundamental changes in utility business model and regulation. So that's one bit of hope, because it's a false choice to say that there's a difference between affordability and emissions reduction. In fact, many of the things that we would do to address affordability are things that will be good for emissions and for the market, that will draw in more and more innovation in companies. And I think the second thing is really what is happening outside the United States. I do sometimes worry that the United States may be a petroleum pariah, but the rest of the world is moving on rapidly, and so that's good. That's good. I mean, it may be sad if the United States. It will be sad if the U.S. gets left behind. But climate change is a global problem, and the opportunity to deploy capital and for innovative companies to serve a huge market is only getting bigger.
Well, let's hope that these forcing functions are a source of good, not evil, right? So I think with that, Richard, thank you so much for joining us with Energy Matters with Claire and Dan, and we'll see you next time. Thanks, Richard.
All right. Thank you, Claire, very much.